Hello, everybody. So today is going to be our first lesson or chapter, if you will, working through investing. So you can think of this as your introduction to financial investing. And so, sort of the roadmap we're going to take here is sort of start out very basic, get the concepts, get the terms, so we're all on the same page. And then we're just going to sort of work our way through financial investing with the goal of hopefully by the time we're done, and even as we go through this, you will be able to begin investing yourself, be able to construct a portfolio that meets whatever guidelines you might have. And I think you should be successful in doing that. And so today, we're going to start out with real assets and financial assets. So what are they? What's the difference between the two? What are some examples? How are they used? And then we're going to move on to the three main categories of securities. And so securities are just sort of investment choices. So, and there's a whole bunch of them. We're going to talk about the three broadest today. And then from there, we will move on to, I believe we'll go to active and passive investing. So knowing the difference between the two, I think, is important. And then I guess before that, we'll actually do asset allocation and security selection. And so, what are they? What are the steps involved? And those really are the two important steps for building a portfolio. And so that's where we are. So I guess if there aren't any questions, we can get started. And so we're going to begin, like I say, with real assets and financial assets. So we have real assets. So first, I guess let's first do real assets. And sorry if my handwriting is not great. It won't be great. If you ever have any questions about anything I write, just tell me, and I can fix it. So real assets, loosely speaking, or sort of as the term says, I don't necessarily want to say tangible because there are some real assets that you can't necessarily hold, but well, what they are assets used to produce goods and services. Assets used to produce goods and services. Goods and services. And so that can be a whole bunch of things. So sort of your easy examples are going to be machinery is going to be one. You're going to have buildings. So buildings. You're going to have land. And so I'll sort of try to draw here. You have some land and you have a building on, and then inside you have some machinery doing something. And so all this is machinery building stuff, and those are all going to be real assets. And then another common one is something like a gold bar. So just an actual gold bar. So if you went out and bought a big gold bar, and then that would be a real asset. And so and so these differ from financial assets, though. So let's write financial assets. So financial assets typically will derive their value from the real assets. So these two are inevitably linked. And so the definition here for, let me put a dot here, and so the definition here for financial assets are they are assets whose value has claims. I guess how do I want to say this? But okay, yeah. So let's put assets that have claims on real assets. I guess that's probably the easiest way to say it. So they have claims on real assets real assets. So assets that have claims on real assets, and so the easiest example here is going to be a stock. I think these are probably easier to understand with examples. So stocks, and then so stocks are just like your Apple stock, Amazon stock, any stock like that. And so how these work is you take this building, and this stock has a claim. So let's call this building now Apple. So this is an Apple building, and they're making phones in there. And so when you go online, you buy a stock in Apple, what you're actually buying is that claim on the machinery and the buildings and the land and the cash flows and the whole company. So you can think of it honestly as, if we divide this up into millions and millions of tiny, let's just use dots actually. So we divide this up into millions and millions of millions and millions and millions of tiny dots in here. When you're buying stocks, what you're doing is you're taking a chunk, you're taking some of these dots, and that's your ownership. So you will own a very, very, very tiny percentage, unless you have a whole lot of money, but you'll own a very tiny percentage in Apple's machinery, buildings, land, cash flows, everything. And so that's how financial assets work. You have a claim on these real assets. And then another example, because I use gold bar, I'll put this, so gold ETF. So an ETF is just an exchange traded fund. We'll go into more detail of what these are later, but just so we're all on the same page. So it's an exchange traded fund. And what these are is, so as I said, on the real assets side, you can buy a gold bar. You can go out and buy this big chunky gold bar and carry it around. It'll be very heavy. Or you can go buy what's called a gold ETF, whose value will track the price of gold. So it's not going to be a perfect track. So sometimes gold might go up 10% and the ETF might go up 8, might go up 12. It's never going to be perfect, but in many instances it's easier to do that than to go out and buy an actual gold bar, because you have to store it somewhere. It can easily get stolen, and so it's easier to buy the gold ETF. And there's millions of examples of financial assets and real assets, and if you would like to know more about those, I can definitely give you a whole lot more examples. Just leave me a comment, send me a message, and I could literally do an entire video on financial assets and how they relate to real assets. But for now, I think we're going to move on now to the next thing was asset allocation and security selection. And so I think the easiest way to do this would be, okay, so let's just draw a portfolio here. So this will be your portfolio, which consists of some money. The exact amount doesn't matter for this. So we have a portfolio, and you're trying to figure out, and so you're sitting there saying, okay, I have this money I want to invest. How do I invest it, or what do I invest in? And so your first step will be to apply asset allocation. So asset allocation. All right. And so what this is just deciding. So this is simply just deciding the percentage of each asset class in the portfolio. Of each asset class in the portfolio. And also I guess it's sort of inherent, but I'll write it down, and deciding the asset classes. The asset classes. Oopsie days, that's supposed to be an L. Okay, we do this. And so there's a whole lot of asset classes. You have things like stocks, bonds, commodities, real estate, currency, and a whole bunch of other, and then there's a whole bunch of subcategories of each of those. And so we're going to keep this basic, simple, I think, with ones we all know. So let's start with stocks. So let's say we decide we want to, so let's say we first did this first step. Okay, which asset classes? We decided stocks, we decided bonds, we decided commodities. Simple, a nice simple portfolio. And then next step is, okay, what percentage should we do? And so there's a whole bunch of ways you can come to this. There's a lot of statistical ways, which we will get to. There's also things called, you can also look this up online, called the iBotson asset classes. You can probably just type in asset classes and that should show up. And these are essentially just based on your age. It's a big study based on whatever age you're at. It tells you here's what your asset allocation should be. And so in this case, we're just going to sort of just pick some numbers. So let's just say, because we're not going to do a statistical analysis here, so let's say we want to do 60% stocks, 20% bonds, 20% commodities. And so I guess let me be clear. I mean, I'm not giving advice here, so don't. So I mean, this could be a good portfolio. It may not. I don't know. But just for this example, we chose this. And so the asset allocation decision is just this part. It's just deciding what the asset class and the percentage is. So that'll be asset allocation. And so then the next step now is security selection. And so security selection. And so securities are just going to be essentially what you're investing in. So stocks or securities, bonds or securities, commodities or securities when you're actually buying them. So security selection, I guess the easiest definition is just the choice of investments is probably the easiest. And so I think the example would be even easier. So the choice of investments in the portfolio. And so in this case, let's say stocks. Let me draw a line here. So we have some so we can delineate what we're doing. Alright, and so stocks, let's just say we decide we want to buy Apple, we decide we want to buy some Amazon, and we decide we want to buy, I don't know, I guess let's just say, I don't know what comes to my finance to say we want to buy some Chase. So we decide we want to buy these three stocks, and we could have done some analysis to figure it out. Presumably you would have, you just wouldn't throw darts. And so, and then bonds, let's say we want to buy a 10-year U.S. government bond. We want to buy, I don't know, let's see, I don't know, I guess maybe a California municipal bond. And I guess the two examples. In commodities, we want to buy some gold, we want to buy some oil, we want to buy some aluminum. And so I guess, yeah, okay, let's just leave it at that. So our portfolio now, and then a next step would even be how much of each individual asset you want to buy. And so we can just say, okay, let's just say 20% of each of these and 10%. Let's say, yeah, and then 10%, I guess in this case. Okay, yeah. So you would then decide, okay, based on how much money you have, how much of each stock you would like to buy, and so this part, and so that part is your security selection. This got kind of sloppy, but hopefully it was easy to see. And so that's how you would ultimately construct your, I guess, let me put a little note here. This is just, I guess this asset allocation. And so this would be how you take your money. You have a portfolio. You'd apply your asset allocation to decide what percentage of the asset classes you want and which asset classes. And then you would decide, okay, I'm going to use some security selection to choose the exact assets. And so that's anything, whether you do, and so this is a good segue into now active or passive investing. And so I guess I'll start with passive. So I guess let me clear this out for now. And so let's start with passive. And so passive investing, and then I'll show you how it connects. And so In the last example, we decided we were going to pick, actually, yeah, second thought, since we did an active portfolio last time. So in the last example, we chose these different stocks and bonds and commodities, and so that would be considered active investing because we're using analysis and evaluation tools, which we will learn in time. We'll learn as many valuation tools as you would ever want to know, and so that's what we would have applied before. And so now and so that would be active investing. And so what active investing is when you're seeking to outperform the market. To outperform the market. And the key word there is seeking. I say it's a keyword because number one, you may outperform, you may not, but the key is as long as you're trying to. So you're seeking to, you're attempting to outperform the market. That will be active investing. And so what is the market? And so the market will be just an index. So it'll be an index. And so, maybe most people are familiar with the S&P 500. Let's see if I can do it. Okay, that was pretty good. That was better than I would have expected. So the S&P 500, the Dow Jones, say the Nasdaq, and there's a whole bunch of bond markets. There's a whole bunch of bond indexes as well. And so if you're doing bonds, you can do bond active investing too, where you outperform the bond index. So for instance, you have something like, I guess it's now called it's called the Bloomberg. It's now called the Bloomberg Barclays aggregate index. So aggregate bond index, aggregate bond index. And so if you're trying to outperform any of these, then you are applying active invested management, which is what we did in the previous example. And so, whereas passive investing is essentially not seeking to outperform the market. So, not seeking to outperform the market, seeking to outperform the market. And the market is those examples over there. And so in this case, you're essentially saying, hey, I can't beat the market, so I'm not going to try, because active investing typically takes a lot more work because you have to do a lot of valuation, security analysis. You have to be able to, you're essentially saying, so I guess let me back up and say, with active investing, you're essentially saying, I have information, I have knowledge, I have, hopefully not inside information, that's insider trading, but let's say you have information or knowledge that makes you believe you can outperform the broader stock market. So in other words, you say, hey, I'm going to choose, so I guess let me draw a little quote here. So you would say, quote, I can choose, let's say 15 stocks that will perform the best. That will perform the best. And so if you exclamation point. And so if you say that, you will definitely be an active investor because you believe that you will pick these stocks that will outperform the market. So you'll definitely pick those stocks, Whereas passive will say, I cannot choose stocks. Or you say, maybe not that. You say, I don't know. And you may not even care, but you say, I don't know which stocks will outperform. Which stocks will beat the market. And so in many cases, if you say that, you're just going to be a passive investor. You will what's called buy the index. So you will essentially buy the S&P 500. See if I can, okay, that was good too. It's like we will buy the S&P 500 index. So if the index does 10%, you'll do 10%. Maybe a little less because there are going to be, because you'll have to buy an index fund. Let me put that in here, buy an index fund. And so there's going to be a small fee. The fees are small. We're talking, point 0, 0.01%. So they're very tiny fees. But oftentimes, many people prefer that over the time spent doing active investing. And so I think that's a good overview of both of those. Again, if you have any questions, I could talk about active and passive investing for hours on end. This has been I guess it's actually been, it's been debated for a few decades, but very recently, in the last 10 years, this debate has gotten very, since the financial crisis, this debate has gotten really intense. You have some very large passive investment companies that have come out, and they've attracted a lot of money to their firms, and so it's caused this debate to sort of be reinvigorated, and it'll probably keep going forever. We will go into more details about this debate later, but if you want to know more now, again, just leave me a comment or send me a message. Hey, I want to learn more active investing, passive investing. What's the difference? What do the returns look like? And we can go over that anytime. And so other than that, I think, and so since that's going to do it for us today. So again, you can think of this as chapter 1, just sort of an introduction into some of the broad investment terms. Again, if you have any questions, you feel free to ask me. Again, if you want me to do any specific videos, let me know. I don't mind teaching anything you want. Other than that, I'll just keep going through with the material to make us all investing experts. Soon we'll all be able to make the best portfolios. And so again, if you have any questions, comment, message me, subscribe. Anything you need to do to get more info is gonna help you. And so for now, I will see you guys all next time.